Well, hello everyone. The bell has rung. Everyone has gone back to their corners and our trading day has ended. But for us, after the close has just begun, my name is Barbara Armstrong. I'm a coach with Schwab and delighted that you are tuning into this webcast, whether you're joining us live or watching this in the archives. I'm glad that you have tuned in to check this out. Today, we're going to talk about a quote that I pulled from one of the surveys, that said, is this a class to help stop us from hitting the panic button? And today it seemed that there was a lot of selling going on today, in the last 2 or 3 days, or really in the last couple of weeks. There's been a lot of news hitting the market that's been impacting the markets. So we hate to miss out if things keep going up or go up, but we don't want to have our lunch handed to us and end up compromising our portfolio if things don't go our way. So we're going to look at a way to invest today that protects our positions to the downside. And then the second piece of it will be looking at how we might take advantage of stocks that are moving to the downside and what kind of strategy could we employ there. And then the third prong, or the third triptych in our class today, is going to be looking at a bit of trade management. So that's what's on the docket for today. So buckle up. We have a lot that we're going to cover. If you are not following Connie and I on Twitter, I have the privilege of having Connie Hill, who's a friend and a fellow coach, riding shotgun in the chat. She understands all of these strategies that we're talking about today in spades. So if you have any questions, don't hesitate to type them into the chat. But if you aren't following us on X, consider this your invitation. My handle, Barb Armstrong CS for Charles Schwab. Connie's is Connie Hill CS. Just know that I found a couple of imposters in the past week, so they seem to be rearing their ugly heads again. Just know that no coach will ever reach out to you and offer you a Bitcoin or a crypto deal. They won't offer to trade your account for you on your behalf if you're willing to give them your password. Never do that. We're not offering private education for a fee either. These are all scammers, so please be careful. And if somebody does reach out to you, please take a screenshot or respond to us via X and give us their handle so we can shut them down. So that's that. Let's get through our important information so that we can get it out to the platform and look at what we have going on. Know that everything that we look at in this class is for education and information purposes only. None of it is to be construed as a recommendation on the part of Schwab or myself. We use the Paper Money software application on the Thinkorswim desktop platform, and it is a great tool for us to learn as a learning tool. There are some nuances and differences, and I'll discuss those as we go along. Now, last week we put in some trades, and we're hoping they might fill in the extended hours. Turns out in Paper Money, nothing fills in the extended hours, but there are now over 800 stocks that you can purchase, but it's stocks only. Option trades cannot be placed in the extended hours. Well, they can be placed outside of regular market hours, but they won't fill until the next trading day. So there are nuances and differences. Know that when we use stop orders, they are not a guarantee that we'll get out at a particular price. And so that's important to understand. And so there are really two different approaches, and some people kind of focus more on fundamental analysis, which is looking at the company's financial statements and looking for stocks that are in the value camp. They might be looking for dividend paying stocks. And so they're going to spend a lot of time looking under the hood. And then there are some traders or investors who want to look at the charts. And so they want to look at how the stock price has moved over time. And they're going to, we call this technical analysis. And then there are those that like to marry both. And we're going to do a little bit of the both today. Okay. So that's what we're up to. Now let's go out to the platform. I've reorganized. I have several monitors going on here. And I've just reorganized today how I access them. So I keep flicking around. So the first thing I want to do is look at what we have. And on days like today, when the S&P, and by the way, I'm not spending a lot of time going over the overall market, but today was a down day. It looked like we rallied coming into the close, but yesterday we hit a new all-time high on the market. And so the market has overall been pretty bullish. And over the last year, if we show price as a percentage, the S&P is up almost 23%. And it's the same for the NASDAQ. It's actually up 25%. And yesterday, this index also hit a new all-time high, as it did the day before. So it's hard to characterize the market as anything other than bullish, even though today, if we come to the Market Watch tab, we look, we see a mix. But by the end of the day, how many stocks were up on the day? Well, let's come and look. So we can come over here to the S&P 500. And we see that we were close to an even split. We had about 53% of stocks were down. So that means 47% were up. And on the NASDAQ, 58 to 43, so 58% were down. But you'll notice that the ones that were down, they were down more than the ones that were up. So we had Dash down 5%, Illumina down 5.5%, Moderna down 6%, CEG, down 4%. And then we had Take-Two Interactive up. TXN was up almost 4%. Who were the big winners? Gilead up 2%, and Pepsi, was up 2.2%. And so if you want just kind of a quick overview, this is, where we can see, what was up. And for sectors, if we come and look at just today, healthcare, was the one that rallied the most today, followed by the energy sector and then real estate. And consumer discretionary today took a bit of a hit, as did financials and consumer staples. Ironically, although, it gapped down on the open and then rallied through the end of the day. So when we look at what we have now, what some people will do, so some traders might say, I'm a longer term investor, so I am going to look at all my positions monthly. Now, some of you, and I recognize a lot of the usual suspects in the chat. So, hello, by the way, to Will and John and Greg and Kenneth and Dragon Rider and David and the rest of the gang. Mike, I'm glad you guys are all here. You might check your positions daily, but as part of your official routine, you may say, well, you know what? I'm going to look at and see if any of my stock positions need adjusting, every Monday, or you could make it every Thursday. I mean, totally up to you. But if we went through and did that, I don't normally have my stops or my positions showing on the chart because I find it distracting. But if you want to go through an exercise of adjusting your stops, you could come here to the sprocket and then under general, just say show orders. Well, what does that do for me? Well, we have 3 dividend stocks, Citigroup, AT&T, and Verizon. And, we're up 10% on AT&T, 3% on Verizon, and down just a smidge on Citigroup. So let's go and look at where our stops are, and we'll just do them alphabetically. So here is Citigroup, and here's our current stop. Now we placed the trade this day, and here was our stop. So might we want to move our stop up? And if so, where? Now I'm going to do an example trading plan, which, and this is just an example that says if something comes in and closes below a support level, then we would move our stop up. And it hasn't really closed below a support level yet, but could we say, well, you know, this 30-day moving average might act as a support level. And so we'd like to move our stop up. Let me just change this back here to price. So we could move our stop up to 3% below that. And our current 30-day moving average is at 79.83. And so if we took our calculator and said, okay, if I took this 79.83 and multiplied that by 0.97, and you know, I'm using 3% just as an example, but we could use any number. We could use 2%, we could use 5%, but you know, in this example trading plan, we're going to use 3%. So we can just grab this, and it's currently, our stop is at 76.69. We can just drag it and say, okay, we wanted it to be at 77.40. And when I release it, it brings up this number that says, do you want it at 78.60? Nope. Actually, I want it at 77.40. And so I'm going to confirm. And by the way, stop loss orders do not stay in the system forever. I believe it's either 3 months or 6 months. Connie, do you know? I know it's one or the other. But if you're adjusting a stop, then that clock starts ticking again. And again, this doesn't guarantee that if it came down to this price that we would get filled. If it gapped down, we could end up out lower. So the second one was AT&T. And man, this has had a great run. We bought it on this day, and our original stop was down here. And so if we wanted, as part of our routine, to say, well, one, when I'm here, we can remove some of these extra lines. You know, maybe we just want to use this, the low of this day we got in even, or we could use this 30-day moving average again, which seemed to be working nicely for a lot of the last year, right? Until we got here. And then we had this little pullback. So if we took this 30-day moving average again at 23.78 and we multiplied that by 0.97, that would give us 23.06. And our stop is currently at 21.73. So what we're trying to do is manage our risk here. And so we're going to just click and drag. And again, that gets us close, 22.99. Well, we might just say, you know what? How about we just move it up to 22, say 89? Because the market seems to like round numbers. And often a round number can act as a support, like that $23 level. It's still below this level here. Okay, so if we confirm and send, just let me catch up with the chat. Stops are good for, 6 months. Okay, so now here's our stop. And eventually what we want to be doing is protecting some of our profit, right? Right. Okay, so that's AT&T. Number 3, Verizon. And so Verizon, we placed that order last week, and I don't know why this stop is down here. Maybe that was a typo on my part, but it has just gone up to beat the band, because the market was closed. This went in on Friday. So this was Tuesday, Wednesday, Thursday. It's moved up really nicely. So might we assume that this $40.80 mark might act as a support level? And so could we take this and move it up to 3% below that, which would be about 39.58? All right. Okay. And again, edit. $39.58. And so now our stop is here. So it's still giving it lots of room to move. And some might say, well, why wouldn't you make it tighter? Well, we could, but then the probability of it being stopped out is higher. Yeah. So that's why we're doing it that way. Okay, now let's go and look at a new position. And one of the ways that we can protect a position, and by the way, this is an alert. Why do we have this alert on the chart? Because the note I think that we put in there that said, do we want to sell a covered call when it gets up here? Or do we want to consider exiting the position? Or do we want to just stay and continue to collect this robust dividend on this stock? So it's just a note from ourselves to pause and think about, what we may want to do next. Okay. So, but let's come and look at Altria. So the ticker symbol is MO. And we still have a lot of cash sitting in cash, which we talked about last week. We're pretending we had $1 million in this account. Now, you might want to pretend you have 100,000 in your account, but we just inherited this nice, tidy little sum of money. And so we're going to be investing that over the next few months and then managing it. And we're going to be looking at kind of three things. One, how to protect this giant heap that we have inherited. Two, how to grow it. And two, how to generate some income. Maybe we'd like to be able to take, a certain amount out every year. And so, could we, at this, depending on age and stage, say, you know what, I've got already a retirement, and I don't want to spend this entire $1 million, but if it could generate some money for me on an annual basis, 50,000, 50,000 on $1 million, that's just a 5% return. Not just, but that's a 5% return. 100,000 would be a 10% return. And so you might want to set some goals for yourself and have an idea of what you're aiming for. And so today I thought we'd look at ways that we can invest that will provide income while we're protecting ourselves to the downside, should the market have a really negative reaction to what's going on, or should a particular stock get hit with bad news. And so, what does Altria sell? Well, they sell smokable and oral tobacco products. And so for those that smoke, might they smoke more if they're stressed? And the smokers I've known in my life, the answer to that would have been yes. So last year, their earnings per share was up 30%. Their sales per share were up just a modest 3%, but we can see that sales per share have been steadily growing. And we can see also that with the exception of 2020 to 2021, when there was a pullback, their earnings per share have been growing nicely every year also. And then when we come and we look at the trade tab, this pays a dividend of 7.5% and has a price earnings ratio of 8.3. So what does that tell us? Well, it tells us that for every $8.30 you invest in this company, it generates $1 of income. So this would be in that value category. And if we're thinking that some investors might be looking for stocks that are less volatile, might this kind of fit the bill? And for some, it might. And so if we looked at this and said, well, it's up, 1.8% today. If we wanted to do something to generate income, we could say, well, when it gets back up here around 58, we'll reevaluate if we want to stay in this position. But maybe we could look at, at other things, but we might want to put in an alert. Should we buy shares of Altria? And, our position size in this account because we started with $1 million, our max position size is 5% or a $50,000 position, and we don't want to risk more than 3,300. And so if we looked at this and said, well, how can I protect myself to the downside? Well, stop loss orders are one way that we can attempt to protect ourselves. Another thing that we could do is buy a put. And this stock is, it has a beta here of 0.67. So what does that mean? It means it's not a terribly volatile stock. So if we look at the chart and we said, well, if I could put in protection here, maybe around this $51 level, around the $50 level, let's see what it would cost me. Well, if we looked out here in March, we could buy a put at the 52.50 strike, okay? And it would cost us between 35 and 46 cents. And why would I look at buying a put? Well, if I buy the stock and I buy a put at the same time, it's called a married put. What it allows me to do, and this would be at 52.50. Let me just put that number on the chart. It says that between now and March 21st, I have the right to sell my shares or 100 shares per contract of Altria. And so how many shares could we buy if we could buy $50,000 worth? Well, we could probably buy 900 shares and we'd be under that $50,000 limit. And then how much are we risking? Well, we're risking 54.33 minus 52.50. So we're risking $1.83 a share, plus we have to add what we paid. And let's just assume we're paying about, let's call it 45. So we're risking $2.28 a share. So if I multiply that times 900 shares, we're risking just over $2,000. Okay, so if we look at that and we say, well, we can risk up to 3,300, so that would be within both our position sizing and max risk guidelines. Okay, so we are going to come here, and because I am buying this, and then I'm going to come down to single order, and for some reason this is showing up on a different screen. I'm going to choose first trigger sequence, and then I'm going to come up to March, and I'm going to click on the buy. And so we're both buying the stock and buying a put. And I don't want 10 of those. I want 9. I want to buy 9 puts because I want to buy 900 shares of stock. Okay. And I'm going to put these in as a day order. And even if I were in a live account, which I am not, the buy order on the stock could fill, but the put order would not. And so we're just going to have them both fill in the next morning. So if the stock goes up, somebody is asking the question, and I like the way you're thinking, when do you sell the put? Well, you might agree, have this conversation with yourself and say, I'm going to hold this, right until expiration, just in case. And others might say, hey, if this continues to go up, then, I might choose to exit it when it's, maybe I can get, half of my money back. But it's like buying short-term coverage. I say buying a married put, it's like you planned a trip to Paris and you just want coverage in case you fall and break your arm. What you're hoping is you'll come back from Paris all in one piece, and there won't have been any need to have used that extra coverage plan. it's going to expire worthless, but it was worth it for the peace of mind. And so that's up to each individual investor. Okay, so we're looking at buying our 900 shares. This will, and you know, I've got this in at the closing price. And, you know, it may be a slightly different price in the morning. So the one thing you'll want to do is go in and check just to make sure that this order fills. So this is under, it is under 48,000. It's saying you could lose all 49,400, 48,897. It's not taking the put into account. And the put, there's a 65 cent per contract fee for the put. Okay, and we are going to put this in our dividend stock category. But it comes, you know, it's a dividend stock with protection. Okay. Okay, so that's our first one. The second one I wanted to look at was AEP. So American Electric Power. So this is in the utility sector. You know, it looks like analysts seem to be favorable, and you could click on those reports if you wanted some detail on them. But, you know, when we look at earnings per share, that was up 24% last year. Their sales went up modestly. And again, this is a stock that pays a dividend, almost 4%. And, you know, many consider stocks that have a price earnings ratio of under 18 or under 20 to be in that value category. So it's kind of checking those two boxes. And way over here where it says beta, a beta of 1 means that it moves similarly to the S&P 500 with respect to volatility. So a beta of 0.56, you know, means that this is kind of more of a steady eddy type of stock. Now, that doesn't mean that it can't go up dramatically, and we saw that it has, and that it can't go down dramatically. We've seen that it has. But what, you know, and I posted this picture on X yesterday. Just let me grab my drawing tool. Yeah, I posted something else today on Twitter too, obviously, because that was the last thing that I wrote. So pardon me, but this is going to look pretty similar, my friends, only it's down a little lower. So we had this. This is what technicians would call an inverted head and shoulders pattern. And so what that technician might be looking for is it to break above. So they're looking for a breakout. And then sometimes it will come back and retest. And then it could come all the way back down. But, you know, and sometimes it'll bounce, and sometimes it just breaks out and it just keeps on going. You know, so, you know, there's no crystal ball. We don't know what will happen. But in measuring this range, it's about $10 from top to bottom. And so a technician might say, well, I'm expecting this to maybe go up to about 110. But when we look at this, this is another one, you know, price earnings ratio, it pays a dividend, you know, and is a more of a steady eddy. Somebody's saying it looks like Casper. It kind of does, doesn't it? You know, Casper the Friendly Ghost. So it's got some interesting features fundamentally. And it's in a sector that many will look at if things, you know, volatility starts making them uncomfortable. And again, if we were to add a position, could we do that same idea of buying the stock? Now, this is a more expensive stock, but buying the stock and then marrying that with a put. So some call this a protective put, and it is. Some also call this a married put because we're marrying the purchase of the stock with the protection of the put at the time we're buying the stock. kind of like you book your trip to Paris and at the same time you book your coverage just in case, just so you don't forget. So that's what we're looking to do here. And where might we put a stop? Well, we might say, well, our expectation is that this kind of 101 level was acting as a ceiling. The expectation is that that might now act as a floor. And so if it goes much below that, like, you know, here's 101, here's 100. You know, if maybe we buy it, this put at 100, that would be $4 of risk. And what might that cost us? Okay, well, let's go find out. So we're going to come to the monitor tab, or sorry, we're going to come to the trade tab. And, you know, again, our yield 3.56, price earnings ratio under 20. We're going to come out to March. And again, this number here on the option chain beside 21 March at 20%, 20% implied volatility is at the lower end of the spectrum. Like if we look at something like a NVIDIA, now NVIDIA has earnings coming next week, 61%. So 3 times as volatile as AEP. And it shows in the price of the option. So here's 140, here's something $4 less, $6.70. And then here's AEP. Now it's not quite apples to apples because they're not the same price, but you know, it's close to, it's 104. The 100 is 60 cents. So it's less than 1% we're willing to pay to make sure that if all hell breaks loose and the whole market goes down and takes our stocks with it, or if some news comes out on AEP and the stock all of a sudden goes down, you know, even though it's not an earnings event, this is just a conservative way of protecting ourselves, of spending a little to buy ourselves a good night's sleep. Somebody's saying it's kind of like a prenup. I'm going to call this the prenup put. I like that. Wiley always comes out with great stuff. Okay, so how many shares could we buy? Well, it's 110,000, you know, 100, well, 10,400. So if we bought 400 shares, how much would, you know, that would be under 50,000 for sure. And then if we're risking $4.35 a share, plus we have to spend, let's say 70 cents. So 435, let's just call it $5 a share times, if we bought 400 shares, 2,000. Is that less than 3,300? Yeah. So we're honoring our position sizes. So, and I mean, the one thing, if you had you were saying, I'm going to play along, but in my paper money, I'm pretending I have $100,000 account, then you might buy 100 shares and then do one contract, right? So we're looking to buy, and then again, we're going to make this first trigger sequence. The drop-down menu for some strange reason is showing up on another screen of mine, but we make this first trigger sequence. Then we come up to our March 21st put, and we are going to buy it. And how many? We're doing 4. So we're only buying 4 puts. Confirm and send. So this is a $41,000 position. Is that less than 50,000? Yep. We're paying $260 for the puts in transaction fees. And again, this is assuming that this whole thing goes to 0. But we know that we have the right anytime between now and March 21st, if we want to sell these shares for $100, we can pull the trigger and sell them. Okay? Okay. So we're putting this in our dividend stock group as well. And then we will check in the morning to make sure that both of these have filled. And this buying of 400 shares, the second order, the buying of the put, is predicated on the buying of the shares. So this order doesn't go in until this one fills. Okay, so that's our second one. Now, what about, now if we wanted to do a third practice, we could look at T-Mobile. Now we already have AT&T and Verizon in our portfolio. But if you wanted to practice this strategy, you could look at T-Mobile as well. But I thought it might be interesting to look at Albemarle. Now, why might we look at Albemarle? Well, this stock, has not been doing so well, has it? Year to date, it's down 4%. And it's been, kind of trading in this big range where it came up here and it fell. And the last couple of times it's tried to rally on its way down. It came up here to the 30-day moving average and got knocked down, and then came up, and it looks like it's getting knocked down again. So we could look at a stock like this and say, it looks like this might continue to fall. Or we could look at a Restoration Hardware, which has been getting hit. Or a Nike, which, when you look at the 100-day moving average, it seems every time it gets up to that 100-day moving average, it just doesn't have the strength to get through it and stay there. It did here for a hot minute back last September, and that lasted like under 2 weeks, and then it was back under the gun again. So, but with Albemarle, and you might say, well, if I'm using stock, how can I, trade that bearishly, which means I'm expecting that the stock might continue to go down. Well, could we buy a put and then have a swing target on it and say, my expectation is that this will come back down to around that $72 mark. And so if we look at this, so this is buying a put for a different purpose, and the purpose is to take advantage of something that might be falling. And so if we look at this and say, okay, it's now at 82, I'd like to buy the put and then put in an order to sell it if it gets back down here around this $73 mark. So if we look at buying a put out in March at the $80 level, okay, we've got tons of contracts here. And this is saying, at 82, it's saying, we've got an 83% chance that it will go, it will at least kiss 83. Or sorry, it will at least kiss the $80 mark between now and March 29th. And we've got a 43% chance it will close below. But our goal is for it to come down and kiss that around the $73 mark. So at the 75 strike, it's saying, you've got a 53% probability of it coming down to 75. It kind of gives us an estimation. And these numbers are fluid and they will change. But so if we look at buying this put, and we may not want to risk 3,300 on this trade, but we might say, well, we'd be willing to risk 1,500. And so we're going to look at buying this put because we could lose the entire amount. And if we buy 5 of them, we'd be risking over $1,500. So we'd be risking $1,725. If you're saying, well, this is a newer strategy for me, I know I can risk up to 3,300, but I'd rather keep it at that around the $1,500 mark. Well, then we'd say, okay, we're going to buy 4. And then we're going to put in an OCO order. And so I'm going to just come out here and kind of do this again. We're going to buy custom with an OCO bracket. and we're going to put our stop in at about 50%. So 345 times 0.5. Say we'll call it 170, 175. And our exit is going to be based on the price of the stop. And so these are going to both be good till canceled. I'm going to say, hey, when this gets down, or if it gets down to about the $73 mark, okay, okay. This is disappearing on me. So I'm going to have to fix this after the class, but this should bring up a conditional order, which it is. It's not appearing on my screen. So what I will do is put this in at the end of the class and say, if and when this gets down to 73, we want to exit. Okay. So I will tee that one up, and we don't want to do 10. We want to do, oh, and now it's stuck. Okay, just one sec. Because now it won't let me do anything. Okay, here we go. I just had to change something. So now here's my symbol, Albemarle. If it goes at or below 73, we'd like to exit. So save, confirm and send. Oh, and we want this to be 4 contracts, not 14. So we're risking $1,380. We could lose all of it. We want to buy 4 puts because we are bearish, and we want to sell if and or when Albemarle goes at or below $73, or if the value of this put drops by 50%. Okay, and we are going to all create a category for this tomorrow, so we'll see it next week. Okay, and we're going to send that in. Okay, so let me just close this other window I had to open to get things working again, but I appreciate you taking some time with me today. There is a survey in the chat. And so if you would click on that and just take a second to fill that out if you're with me live. 1 means I hated it, 10 means I loved it, and then you've got everything in between. And if you put a comment in, I promise to read it, and so will the management team. You also, I'd appreciate it if you would hit the like button. What that does is it moves this up in the algorithm so more people can find this content. It also lets Connie and I know that you found this to be worthwhile content for you. And then follow us in the land of X, Barb Armstrong CS and Connie Hill CS. And last but not least, if you haven't already subscribed to this channel, you'll want to consider doing that as well. So what we did today, and one of the comments that often comes up in the surveys is, could you review what we did today? So we looked at married puts where we're buying stock and buying a put at the same time. We did a stock with a married put on Altria, ticker symbol MO, and AEP. And then we looked at potentially taking advantage of a stock that might be moving to the downside by buying a put. So we bought 3 puts, 2 were married puts to protect something we're expecting to go up, and 1 we bought to take advantage of something that may be going down. So this class focuses on how you can look at investing if you can't participate during the day when the markets are open. And we'll look at lots of different strategies over the years. But at this moment, we're trying to get some of our money invested and look at a balance of protection, income generating, and growth. So guys, have a really awesome rest of your day. We'll see you back here tomorrow for another jam-packed day full of great webcasts. Bye for now.